Real estate. It's the American dream, a monopoly board come to life, and sometimes a horror movie all rolled into one. We've all heard the stories, fortunes made overnight, markets crashing faster than a bad Tinder date, and everyone claiming to have seen it coming. The truth is, predicting real estate downturns is like trying to catch a falling knife. Tricky, risky, and you're likely to get burned. But hey, who doesn't love a good challenge? This isn't about timing the market perfectly, because let's be honest, that's about as realistic as finding a unicorn giving out investment advice. Instead, it's about understanding the forces at play, the whispers of change, and the subtle or not so subtle clues that suggest a storm might be brewing. Just like your grandma's questionable fruitcake, some things are best avoided, especially in the world of real estate. So, whether you're a seasoned investor, a first-time buyer, or just someone who enjoys a good economic thriller, strap in as we decipher the cryptic language of real estate crashes. From interest rates that soar higher than your caffeine levels to unemployment numbers that are about as fun as a root canal, we'll unpack the factors that can send property values tumbling faster than a Jenga tower after one too many cocktails. Remember, knowledge is power, and in this case, potentially a very comfortable retirement. So, let's dive into the fascinating, ever-evolving world of real estate, where fortunes are made, bubbles are burst, and the only constant is change. First up, let's talk interest rates. These little numbers are like the puppet masters of the real estate market. When they're low, borrowing money is cheaper, more buyers jump in, and prices climb. But when those rates rise, it's like someone hit the brakes on a speeding train. Mortgages become pricier, demand cools down, and that dream home starts to feel more like a money pit. Next, we've got the unemployment rate, aka the economic rain cloud. When unemployment is low, people feel confident, they spend money, and the housing market thrives. But when jobs disappear, people tighten their belts, and the housing market feels the pinch. It's a classic case of supply and demand, folks, with a hefty dose of economic anxiety. And finally, we can't forget about property values themselves. Remember the good old days when your grandpa bought his house for the price of a used car? Yeah, those days are gone. When property values rise too quickly, it creates a bubble, and we all know what happens to bubbles. They burst. Think of it like a game of musical chairs, but instead of chairs, it's overpriced houses, and nobody wants to be left standing when the music stops. So there you have it. Interest rates, unemployment, and property values, the big three indicators that can make or break the real estate market. Keep a close eye on these bad boys because they're like the canaries in the coal mine. When they start acting strange, it's time to pay attention. They say history repeats itself, and while that's not always true, thank goodness for modern plumbing, when it comes to real estate, there are definitely some patterns worth noting. Remember the housing bubble of the mid-2000s? Easy credit, relaxed lending standards, and a whole lot of speculation led to a frenzy of buying, driving prices to unsustainable levels. Then the bubble burst, leaving behind a trail of foreclosures, bankruptcies, and a whole lot of regret. Now, before you swear off real estate forever, it's important to remember that not all crashes are created equal. Some are relatively mild, like a gentle market correction, while others are more like a full-blown economic earthquake. The key is to learn from the past, identify potential red flags, and avoid making the same mistakes twice. Easier said than done, right? Look for trends like rapid price increases, a surge in speculative buying. Think people buying multiple properties hoping to flip them for a quick profit, and loosening lending standards. Remember those no-doc loans? Yeah, not a good look. These are all signs that the market might be overheating and heading for a correction. The good news is that by studying historical patterns and understanding the factors that contributed to past crashes, we can better prepare for the future. Remember, knowledge is power, and in the unpredictable world of real estate, a little bit of historical context can go a long way. Gone are the days when real estate was a local game. Thanks to globalization, what happens in Beijing can impact housing prices in Berlin, and vice versa. We live in an interconnected world, and the real estate market is no exception. So, while it's important to keep an eye on your local market, it's equally crucial to understand how global economic trends can trickle down and affect your neighborhood. For example, a slowdown in China's economy, a major player in the global real estate market, could have ripple effects across the globe, impacting demand for everything from raw materials to luxury condos. Similarly, political instability or a financial crisis in one part of the world can quickly send shockwaves through the global economy, influencing interest rates, investor confidence, and ultimately, real estate markets far and wide. Think of it like a giant game of Jenga, where each block represents a different country's economy. Remove one or two strategically placed blocks and the whole tower could come crashing down. Okay, maybe that's a bit dramatic, but you get the point. Global events matter, and ignoring them is like trying to navigate a maze blindfolded. You might get lucky, but it's not a risk you want to take. So how do you stay informed in our increasingly globalized world? Pay attention to international news. Keep an eye on major economic indicators. Think GDP growth, inflation rates, and yes, even those pesky interest rates. And don't be afraid to consult with financial experts who have a global perspective.